This is a presentation on the 10-step process for developing a financial plan for your small business. My name is Matt Evans, and in early 2027, I plan on launching this software platform. I want to go through the step-by-step process on how the software works, which is located at startupfinancialplan.ai. So, as somebody who has probably met with over 500 small business owners over the last 7 years here in the United States, it is a real common pain point for small business owners and founders of businesses to raise money and to understand the financial aspect of running the business. And it's one of the biggest reasons why they go out of business is they run out of money. They don't understand money real well, and they don't have a real strong financial background. They're trying to build a product or do a service. And 80% of the people who create a business in the United States create a business because they have a great trade skill or something they're exceptionally good at. So what I'm trying to do is, having met with so many different business owners throughout the years, is I want to get rid of a lot of these pain points and distill this down to just the essential inputs that I absolutely have to capture and make it real easy for you, the small business owner, to understand what those inputs are. So I kind of distilled it down to 4 major inputs, which is basically, you got to know what your total investment is in the small business. Call that the startup cost estimate, step 1. And then I got to have some way to raise the money. And there's 3 components to the funding plan, and it walks you through that process in step 2. Then if I'm going to do a financial statement and a financial forecast for you, I've got to know the revenue side and the expense side. And that would be steps 3 and 4. So if I can just cover these 4 basic inputs, then I can process all of that data using artificial intelligence and all the business rules and tables, including the loan amortization schedules and the contingency reserve calculations. I'm going to do all the calculations for you, so you never, ever have to enter anything into a financial statement or a spreadsheet. And that's kind of like phase 3 outputs. So you get all 3 financial statements, and you get all of that put into a PDF report and an Excel workbook. And that is, in a nutshell, what this software is going to do for you. So, they have this thing, they call it the 80-20 rule. It's now more like the 90-10 rule. So literally 90% of the time that you're going to spend building a financial plan using this software, 90% of the effort's captured in 4 steps. These 4 input steps is where you got to put some real thought and time. And it's kind of like going down the yellow brick road. You start at the very beginning, because if you do not start with step 1, then there's no way I can really truly prepare a complete set of financial statements. I got to know what the assets are, what kind of investment is in inventory. I got to know some basic things. Otherwise, it's going to be hard for me to really do a complete set of financial statements. So you need to start and go through steps 1, 2, 3, 4, the 4 input apps, and put some real thought into this. Because if you really do this and do it really well, and this is where you're going to spend 90% of your time, everything else downstream from here becomes so easy, so fast, and so complete, and really accurate, and very, very high quality, extremely high quality financial plan for your business. Step 1, startup cost estimate. I got to know the total investment it takes to get to 2 milestones. You got to get the first customer, then you got to get to basically what we call the break-even point, where you have enough money coming in from customers to cover your operating expenses. And the startup cost estimate has 3 components. One-time asset investments. It calculates the depreciation. It tells you what the useful life is for all the different kinds of assets. It's pre-populated. It takes the guesswork out of it. It gives you a template for getting your monthly operating expenses. And it asks you with a recommended table what the cash runway should be on the operating expenses, because you're going to have to cover operating expenses to get to break even. And the third piece of this puzzle is you got to cover some unknowns. And it asks you for 9 questions. It says, answer these 9 questions and score it. I'll score it. I'll figure out the contingency reserve. I'll calculate the cost estimate. This is the real, true, total startup cost estimate for your business. This is what it's really, really going to take to get to break even with all unknowns and everything. That's step 1. So now we have a real, true cost estimate for the business. Then step 2, how are you going to fund and cover this? 3 components to this, okay? Equity, that's 1. 2 is income sources, that's like crowdfunding and grants. And 3 is debt. And if you have assets in step 1, it will automatically in step 2 do some asset-based financing for you. It'll take the useful lives. That carries forward into the term loans. So it takes all that information and it pre-populates it from step 1 to step 2 to help you figure out exactly what the debt should be. And it has a table in step 2 to give you recommended APRs. That's the percentage interest rate for the loans. You punch that in. It automatically does the loan amortization schedules and the debt payment schedules. And it maps it all out for you. So you don't have to touch any of that. And then you get to step 3, basically, which is the revenue forecast. And the revenue forecast or sales forecast includes any income sources from step 2. So it picks up everything from step 2. It's all integrated. You don't miss anything. So I'm covering, that's sales pricing. And it also has recommendations on how to aggregate and group products and services, because it can be real tedious to sit there. Well, I sell hundreds and hundreds of products. How am I going to do that? Well, it gives you recommendations how you can group it together. Okay, so it's going to figure all that out for your revenue forecast, including any income sources. And then you go to step 4, which is I got to get all the expense side. That's the cost model, and there's 3 components to that. Direct cost, which is cost of goods sold, and it gives you 2 choices on how to calculate that. We can do it at a detail level, product or service level, or we can do it at an industry level. That's a real quick way to get there. So I'm giving you a couple of choices on how to get it right. Then I have the operating expenses that I kind of estimated in step 1, but now I want to map it out for 12 months in step 4, and I want you to put, and it gives you some ideas on recommending how you should vary it so it's not just flat line. I'm trying to get it right. Okay, so I got my direct cost, that's cost of goods sold. Indirect costs is operating expenses. And then you have some non-operating expenses, like the interest expense from the funding plan. Step 2 will go into the non-operating expense line item in step 4. All this stuff is integrated. It's all complete. You don't miss it. You don't make mistakes. It's all calculated for you. And guess what? As someone who has mentored over 500 people, and because this is such an important, these 4 steps are so important that you get it right, I am not going to charge anything. These will be free for every business owner in the United States. And not only that, these apps have PDF report exports. That means when you do your startup cost estimate, you can export it as a PDF file. All 4 of these steps will be free because I don't want you to be hindered by anything, because you've got to get this right. You've got to spend time on this. And I'm going to make it free. There'll be PDF reports for all 4 of these. So to me, if you're a business owner in the United States, I mean, look, you absolutely should be using these 4 steps. They're free. They're PDF reports for you. And this is a no-brainer. I mean, you absolutely should jump on this once it gets launched in 2027 at startupfinancialplan.ai. So let me go through each of these 4 steps on a slide by itself, because it's so important that you get this right, and it's so important that you understand it. Once again, let's go through this in more detail. So there is a startup asset purchase template that is at the very top of App 1, Step 1. And it is pre-populated with all the different asset types, including any intangible assets, which probably you will not, I don't think you're going to purchase patents, but it has provisions for all tangible and intangible asset types. All useful lives are pre-populated ahead of time with a complete list of assets. Okay. It is going to require that you put in the total acquisition cost of the asset. That's the cost to completely put the asset in service. So that, what does that mean? What do you mean by that, Matt? What I mean by that is, if you buy a piece of equipment and they got to ship it to you and you got to pay someone to install it, you got to take all of those costs into account as the total acquisition cost. And you put that down as the total amount for the asset. Total amount to place the asset in service, that's the amount, okay? And you just say you bought a piece of machinery, or in this case, let's say a delivery van or whatever it is. So the total cost, we'll just stick with the delivery van example of $50,000. You run a delivery business, you buy a van, $50,000. It's going to say, okay, it's a vehicle, and vehicles typically have a 5-year useful life, and it allows you to change the useful life. If you want to if you don't want to use the default value on the useful life, you can toggle it. Just hit the up arrow or the down arrow to change it to 6 or 8 years or whatever you want to do, okay? And then we're going to keep it real simple, but it's going to calculate the depreciation using a straight line method, because this is book. This is financial reporting. This is not the tax return, not to be confused with the tax return. We're doing financial forecasting, not the tax return, okay? So we're going to keep this simple at straight line depreciation for books, not tax. And it will require, the app requires that you put in a down payment amount. And whatever the balance is, it's going to consider that a term loan, which will carry forward to step 2. Okay, so that is how the first component works in step 1. That's A, startup asset purchases. Then there's an optional B step that says, okay, if you're going to sell products, or if let's say you're a professional service firm and you're going to bill out admin assistants or someone like that, and you need to bring people on board and put them on the bench to ramp them up. So there is what we call a ramp up option. That's B, the initial ramp up, usually for product inventory or billable personnel on the bench. And it's itemized, and you can put, well, I need to put a little bit of investment and money into that. Then C would be monthly operating expenses, and it has basically a listing, and you can delete or add and change the operating expense structure however you want to. You can customize it. You can customize the operating expense section however you want to do it, okay? And it's going to just ask you for 1 month only to keep it simple at this point. I'm trying to keep it simple because most monthly operating expenses are recurring. They don't change much. In fact, a lot of times we call them fixed expenses, fixed. So right now we'll treat this as just 1 month. You can add or delete and set it up however you want to. But here's the other thing it's going to ask you for. It's going to ask you for the month's runway, and it has a table, and it says this is what we would recommend based on your type of business. And I would recommend 12 months actually. You say, oh my gosh, that's a long time, but that is what the research is showing. So the recommended runway for operating expenses, OPEX, is 12 months. That creates the operating expense runway, which is probably the single biggest expense in the entire startup cost estimate. Again, it gets back to 80-90% of your cost. This is where like 90% of your cost may reside for a lot of you, especially if you're professional service firms. And then the last one is D, contingency reserve, and it will ask, and it'll score you on 9 questions as a table that will build out a contingency reserve between 5 to 30%. So I would recommend you definitely have some type of a contingency reserve for unknowns, because that's just invariable. That's gonna happen, and it adds all of that up and says this is what the true total investment is it's going to take. Really, this is the reality that I think business owners need to go through. So to get a real true startup cost estimate, that is step one in this process. Okay, so let me continue with the deep dive of the steps, especially the input steps. So let's move now to step two, where I want you to develop a funding plan to try and cover as much of the total startup cost from step one. And we'll compare the two numbers and it'll show you what the shortfall or surplus is in step two. And there's certain components. Remember, I talked about this 80-20 rule or 90-10 rule. Here we go again. The 80-20 rule applies to step two. 80% of the money that you're going to raise in your funding plan is going to come from you, friends, family, people, outside investors, college alumni. You got to push as much as you can on the equity side. This is either ownership or you got to pay these people back. If you're obligated to pay back the people, that would be a loan. That's debt. So it's either equity or debt. So you have your own money. You try to get as many outside people maybe to help you out, partners, family, friends. You got to push. And then we might have to borrow some money. And in between those layers is what we call income sources of funding. And I try to push that really hard because it is not going to impact the ownership of the business, and it has no obligation to pay it back as a loan. So if it's not equity crowdfunding, it's just crowdfunding like a GoFundMe campaign or a grant or a pitch competition or something like that, it will be classified as other income. So you basically have three components of funding in step two. Equity, that's ownership. Income sources, such as pitch competitions, grants, crowdfunding. And the third would be loans and borrowed money. And most of that will probably be asset-based financing. And I would definitely encourage any startup business to establish a line of credit, LOI line of credit, or LOC line of credit, to cover operating expenses. Okay? And the SBA stands for Small Business Administration. And typically, I would encourage people to visit a bank that participates in the SBA loan program. SBA, Small Business Administration, does not issue a loan. It guarantees the loan so that if you can't pay it back, the bank gets paid back 75 or 85% of the outstanding loan balance. So the risk is substantially reduced by the bank when it participates in the SBA loan program. So that's one of the reasons we try to get people to go through a bank that actively participates in the SBA loan program. So these are some of the things you got to think about in your funding plan. And on the right side of the slide is the calculations. We're going to do a lot of the calculations in the application, like the loan payment schedule. And you can print, by the way, when you export the PDF file from step two, it will print off all the loan amortization schedules for all your loans in the PDF report. You'll get the whole thing as part of the PDF report. And a lot of this information we're going to help feed the other steps as well as the financial statement. So you got to put some real thought into this because it's going to help us generate some of the other stuff downstream in this process so you have a really, really well thought out, really good financial plan for your startup business. Probably the hardest and most subjective part of the entire exercise is trying to come up with how much you think you can sell. How many widgets can I sell? How many hours can I bill out if I'm a service firm? Or how many landscaping projects can I do in year one? You have to have a sizing parameter, and then you have to take your best guess on that sizing parameter. How many therapy sessions can I do? How many roofs can I repair in a month, in 12 months as a somewhat, and the average duration to repair a roof is 6 hours. So once you figure out your sizing parameter, then you can apply a price to it. And sales revenue is a function of two variables: volume times price. And your price is probably going to be determined mostly by the marketplace. Most people probably don't have a lot of pricing power. So you go study the marketplace and the competition to figure out your price. The subjective part is the volume part. This is the real subjective part. At the very top of the app in step 3 is an unusual exercise that you do not see in financial forecasting. And I put it in there, and it has 3 specific steps. ICP, define your ideal customer profile, step 1. Step 2, there's information and directions on how to do a prospect or lead generation list, basically applying the ICP to databases that are accessible in the public library. That's what we call the total addressable market, or TAM estimate. And then I apply a conversion rate, and there are tables in the app, the direction and guidance to tell you what the conversion rates are based on how you approach the TAM audience. And that gives you some idea what the true volume number will be. And it's just an exercise at the very top of the app to give you this reality check on something that is very subjective. So price is pretty much determined by the competition in the marketplace. It's the volume that is very difficult. And if you see the example on the right side, we got 4 products. We determined the price per the marketplace, and we went through an exercise to figure out what the volume we think we could sell. Volume times price equal revenue. And this app will also, in step 3, capture any income sources from step 2, the funding plan, so it's complete. So this is how we're going to work step 3 in developing your financial forecast using this application. So the 4th and final input step will be capturing all the expenses and cost. And you have 3 sections to this, basically. And that's going to be the direct cost, or cost of goods sold. Then you have operating expenses. And then there's a third component, which is not very material, which is non-operating expenses, such as the interest expense on the loans. And once again, these steps work hand in hand. So that means that means a lot of the information that you entered before will carry forward into this step, for example. Okay, so like we had we estimated the units and volume that was sold, right, in the previous step, which is the sales revenue forecast. So this step will pick up all those volumes for all the products, all the services, and all the months. You don't have to re-enter anything, okay? But I do need to capture what the cost will be, the unit cost. And the nice thing about this is I'm trying to make it easy. For example, I know a lot of people, well, I don't know how to break out all the cost. Is there some easy high-level way I can figure the cost of goods sold? And what it does is there's 2 approaches in this input app. It says, okay, you can break it out by products and services. And once again, we can aggregate the products and services per the previous step 3. That's where we define the products and services. That's the objects. We call those the cost objects or profit objects. So the objects are defined in step 3. They carry forward to step 4. So all the products and services get loaded into this app at the top of each of the templates input panels. But we need to capture what your unit cost is if that's what you want that detail to be. And that's probably a better, more accurate way to do it. But you can use approach 2, which is an industry approach based on your respective industry. Okay, so we're going to be doing that. The other thing that's nice about the app too, is let's just say you have a sales revenue forecast and the previous step 3, and you sell a specific product and you start selling the product, let's say in July. So what the app does it'll flag and say, okay, in June we need a certain level of inventory to be on hand to meet the July sales. And this inventory control tracking will be part of the next step, which is part of the trial balance process. But the point I'm trying to make here is it will give you guidance on what that inventory should be. It will flag it as to where it begins. And you actually have 15 different major product types. So instead of just calculating the inventory level, let's just say based on, let's say, 30 or 45 days, it has 15 different choices. And there's a range, and it defaults to the midpoint in the range. But again, you get to select how many days of inventory you want to have on hand, because if you have perishable food, it's going to be a lot shorter than furniture and fixtures. So we've built that in, which there's more flexibility. I'm trying to get reasonable accuracy into this, but not burden you with too much. But that's what I'm trying to shoot for. Also, in this process, we want to look at all the 12 months of operating expenses are mapped out. And this is a good point in the process where you may want to put some fluctuation and variance into the operating expenses month to month. So if you increase labor or your marketing budget goes up, let's say in June, July, August, you increase that. So we want to perfect the month-to-month operating expenses in this particular step. And this is going to capture all the non-operating expenses automatically. So that means depreciation gets calculated and captured in this thing. And it's going to capture all the interest expenses, and you don't have to put anything in. It's accurate. It comes from the tables in the previous steps. So it should make this process very, very easy for you and very, very accurate. So at this point in the process, the hard work is done. You've got the 4 input apps. You put some real thought into it. We gave you guidance and directions, and we tried to make the calculations easy for you so you don't have to deal with it. And now the 5th step is to compile and put all the transactions into something called the trial balance. And this is where we want to just make sure everything is accurate and complete. And at this point, we may want to make some accrual entries. And that's going to probably be things like accounts receivable and accounts payable. And there's guidance on how to do those accrual entries so that the financial statements are a little bit more what we call GAAP compliant, GAAP, Generally Accepted Accounting Principle compliant. If you're a startup business, you're not necessarily required to do accrual accounting, but I do want to have some major basic accrual entries, and it's optional. It's up to you. Some of you may have a POS, point of sale type of business where the transactions are almost all cash basis, but other people issue invoices. So if you have sales invoices in December, it's not going to get paid until the following year in January. So, and we also take that into account with C corporations with taxes payable. So what happens is if you're a C corp, we estimate the profits at the end of the year and say in December, and that tax won't get paid until the following year. So this is the kind of stuff that's going on in this particular step, just to get the accrual entries right if you want to apply it in the process. And it's up to you, but I'm trying to give you some guidance on the basic accrual entries so that the financial statements really are more complete and not misleading to any end user who may rely on the information. So at this point, we did the 4 inputs. We got all our inputs. We looked at the trial balance. We looked it over. We may have made a few accrual entries as needed just to make sure that we really have it complete. And at this point, we just want to review the financial statements, the income statement, the balance sheet, and the cash flow statement. That's steps 6, 7, and 8 in the whole process, okay? The other thing is the income statement it's going to be compiled, and you'll have like 2 versions. Like there's a quarterly, compressed, simple version, and then there's a very detailed monthly broken out income statement as well. And we also, in the cash flow statement, we're also going to look at month to month, and if there's any negative balance in any given month, that will be flagged, and you can go back to the funding plan step 2 to exercise like a line of credit to cover any negative balances. That's going to be built in, as well as some basic business rules, maybe like this. Suppose the cash account gets real high. Then there's a rule that says, okay, if it gets too high, then here's some recommendations to reduce it so it's more optimized. So there are some basic optimization rules that are going to be built in here to kind of get this right. This is what we call the review process. I want to review the financial statements, get them reasonably optimized at this point in the process. And if I need to go back, refine the inputs, then come back, review them again to see if you think you got it right. So this is kind of like the refinement loop process. You might think of at this point, I want to go through a little bit of a refinement loop process to get it really right. And then once I'm happy with it, that's it. Now I can crank it out and I'm done. So at the end of the process, there's 2 final outputs or deliverables. And we're going to split those out. Step 9, the PDF report. Step 10 is the Excel workbook. The PDF report, by the way, you have options on how you can include the information from your financial statements. You can include the financial statements. You can include the financial statements and all of the key assumptions that went into the financial statement forecast. And the third thing you can include, if you want to, it's optional, is industry benchmarks. So I've built in the tables at the back end. So if you want to include some what we call ratios, and it calculates the ratios, and it asks you and it'll ask you what type of business or industry you're in, and it basically is using what is called the NAICS, NAICS, North American Industrial Classification System number, the first 2 digits. And if you do your business tax return, you might notice there's an activity code, 6-digit code. And the first 2 digits of that activity code on your business tax return, that is how it's going to benchmark and include the ratios into your PDF financial report if you want to. It's optional. I would encourage you to include all of it. The financial statements, the key assumptions, and the benchmarks. So you get the most out of the software application. So it's a really, really great financial plan. But the last step, step 10, which is probably the key output that most people want, is the Excel workbook, Microsoft Excel workbook. I tried to keep it simple. I don't want to overwhelm people, and I don't like it to over-engineer. But I think you have to see the inputs that went into the financial statements for transparency, because as a CPA or any financial professional will tell you, we want to disclose the transparent and adequate disclosure of where the financials came from, and that would be the trial balance. So tab 1 in the workbook says this is the trial balance, this is where the transactions come from. And then tabs 2, 3, 4 are the financial statements. Income statement comes first, balance sheet is second, and the cash flow statement is last, third, because it needs to capture all the transactions that impact the cash bank account per the revenue and expenses, that's income statement, and the assets, liabilities, and equity, which is the balance sheet. So there's a pecking order that we go in purposely when we do a financial forecast. And then the 5th tab in the Excel workbook is some type of dashboard, and it includes the ratios as well. And you can, and that way you can kind of get a good read of where you are. And in your first base year 1, it may not be great, but you're trying to get the out years and mature the business so you can get closer and closer to those industry benchmarks. So you manage the financial affairs really well for the business. So that is it. 10 steps. Gets you through a very complete, well thought out process. So you'll have a really highly defensible, very credible financial plan for your startup business. It's rooted primarily in things like the Internal Revenue Code of the United States, like useful life of assets, corporate tax rates. But if you're outside the United States, certainly you can certainly use it. I mean, a lot of it will be very, very applicable to any startup business around the world. And the nice thing about this is the business rules, the back end tables, there's guidance documents built in throughout. So it's going to remove so much of the guesswork, like what should be the APR on my loan? How much down payment should be for this type of asset? I mean, it's going to give you guidance so you don't guess so much on this stuff. And if you go to startupfinancialplan.ai, you can also review some of the advanced features that I eventually will try to build out after the initial release, which is called Minimum Viable Product in early 2027. And also, when you go to startupfinancialplan.ai, you can sign up to get notified when the software is released. And if you want complete free access to everything, you can sign up to be a beta tester, participate in the beta test. You'll get inside knowledge. I'll try to counsel people one-on-one. I'm looking for 25 people, and I'll meet with you for at least an hour, maybe more, to help you with your business and really nail it down so I can really get this model completely perfected so that people can really, really use it and leverage it. So anyway, I hope you found this useful. My email address is in the lower left corner of the slide if you need to reach out. And once again, thank you very much for listening.